Happy New Year, MVMA members, and thank you for joining today's webinar, PPP Loan, Next Steps in a Tax Update with Mr. David Kelling. My name is Nicole Cast, and I'm the CE Program Manager for the MVMA. And as many of you already know, my role is to moderate the Q&A. A quick review to help you navigate the webinar functions. Please note that depending on the type of device you are using, you do have the opportunity to minimize various boxes, making the slides larger if you choose. And also note the Q&A icon where you can submit your questions at any point during the session. If you're not able to find the icon, hover your cursor over the bottom of the screen and it should appear for you. I'm delighted to welcome back today's speaker and MVMA industry partner. Mr. David Kelling is a partner at Kelling, Boschowitz and Company Limited. He earned his BS in Accounting and Finance from Mankato State University, now known as Minnesota State Mankato. And Mr. Kelling earned his master's degree in business taxation from the University of Minnesota. Please go ahead, David.
Thank you. We'll get started here today. Got a lot to cover here with all the new tax acts being passed and a clarification from the SBA on our PPP. Here's my information a little bit. The big item there probably is my email address. If a question comes up later, feel free to send me a note and I'll get back to you. Here's sort of the lay of the land for today's Lunch and Learn. Going to look at PPP loans, the first round, then we'll look at the second round. Then I've got some business related updates that should be helpful for your practice. Some individual updates and other tax updates. And then finally, we'll look at the employee retention credit. That one's really been enhanced and it's definitely worth taking our time to look at that. Between each round here, I will pause for questions. I think it's best if we try to address them as we go through. These are pretty heavy subjects. A lot of it's really new, even to me. We're about 2 weeks into most of this having been passed. All right, PPP loan update. For round one, here's where we're sort of standing. Most of you who've got the loan should be done with what they call the covered period. That is the time that you had to spend the loans on qualifying expenses. It was 24 weeks. You could choose an 8, but most people chose the 24 weeks, and that time should be up. So now it is time to apply for forgiveness. If you haven't started that, probably should get going on it. With the new legislation that was signed in, there should be some new applications out here. I do have here the 3508S as the one to be used for loans under 150,000 and 3508 for loans greater than 150,000. The SBA has not issued their newest application form, so I think there will be some changes to that. They had 24 days to get those changes out. So we should be looking at a week from today, they should have forms out and have some guidance on how we apply for this forgiveness. It's supposed to be simpler and easier, but we'll wait to see. I think on the loans under 150, that will definitely be true. I think there'll be a little less paperwork, but I still think we're going to end up having to provide some backup, and we'll go into that a little bit later. The big issue we're having around this is what is Minnesota going to do tax-wise on those loans, and we'll start looking at that a little bit later. And then the other nice update is obviously there's a second round of these loans if you happen to qualify, and those are starting out. All right, let's talk about forgiveness. You've had your 24 weeks to spend your funds, and what could you spend them on in order to get forgiveness? Now, qualifying expenses, the big one, of course, is payroll and payroll-related expenses. So you have your wages, you have your salaries, your commissions, your payroll taxes, your employee benefits, which would include your retirement, the employer's portion, health insurance, again, the employer's portion, vacation pay, family leave, those things related to payroll. You could also have rent if it was to an outside party. If you happen to be renting from a LLC or a partnership that you are also an owner in, then you're going to have to drill sort of down into that entity that owns the building and find out how much the interest portion of those mortgage payments were. You can't just use the rent you pay to your related entity. You can also pick up and get utilities covered for that portion. Utilities also can include some phone expenses. Now, the big rule for the forgiveness is basically what we call the 60-40 rule, which means that 60% of whatever you have forgiven in the loan must be from the payroll portion of the expenses. If not, you're going to have your forgiveness reduced. Another rule on the forgiveness is what they call sort of the safe harbor rule for employee be reduced by more than 25% for a given employee. These are really set in place to ensure that the loans were used for retaining employees. That was pretty much the whole goal of this fact. All right, so on the 60-40, how much of your forgiveness are you going to lose if you don't spend at least 60% on payroll? First, I'm going to say I think most people will have a pretty easy time doing that. When you go back and sort of look at the mechanics of the loans, you were able to receive 2.5 months of salary based on your average salary for 2019. So that was 2.5 months, which is roughly 10 to 11 weeks of payroll. They gave you 24 weeks to spend that. So I think most people are going to be able to take payroll and easily satisfy the 60-40 rule. For some reason you chose or were unable to keep the number of employees up there and your payroll went down, that's where you could come to a little bit of issue. So here's sort of how the mechanics work. Say you had a loan of $100,000 but only paid $50,000 out in payroll. And I have a really high amount here, I know, for rent and utilities, but it just helps me with my example. Say that was at 60. But the payroll has to be at least 60%. In this case, it's only 50. So if you sort of do a little math, 50,000 divided by 60%, your total forgiveness would only be 83,333, meaning that you would have a loan to repay to the SBA of 16,667. I think that's why it's pretty important to make sure you run your payroll through the whole 24 weeks to make sure you have enough payroll. Although the loan terms are really pretty lenient here, the interest rate is only 1%. It starts 10 months after your recovery period is done, and it's amortized over 2 years. So it's not a bad deal, but if you can give it forgiven, that's really the best situation. A little note here is that when you start talking about payroll, only payroll under $100,000 per employee, that's like their annual salary, is allowed to be used. And on top of that, if it's an owner's compensation, the max is only $20,833 for that covered period. Now, there is a couple other rules besides that 60-40 rule that can cause you to have part of your forgiveness reduced. One of the rules is that you need to maintain the number of full-time equivalent employees. And the second one is that the rate of their salary or the hourly rate cannot be cut by more than 25%. This is only true for employees that make under 100,000. Basically, they're trying to make sure that you're keeping your staff employed. Like I said, that was pretty much the reason behind that one. When you're looking at full-time equivalent for employees, that's really what they're looking there is the base of a full-time employee can be considered having 2,080 hours for the year. So we just take the, we'd add up all the hours for all of your staff, part-time, full-time, divide by 2080, and that would be your number of full-time equivalents. The other way you can figure this is what gets really fun with this loan forgiveness calculation, is there's so many little nuances and exceptions and multiple ways to calculate things. You can also look at your full-time equivalents and go with one factor of 1 for every full-time and 0.5 for every part-time. So you sort of have to weigh if your part-time people are generally below 20 hours a week or above 20 hours a week to see which might work best. All right, the employee retention. So now what you're doing here is, once you figured out how many full-time employees or equivalents you have, you're going to compare your cover period to one of 3 reference periods to see if you had a drop in full-time employees, your equivalents. The 3 periods you can choose from are, as I have on here, February 15th of 2019 to June 30th, 2019. Or you can look at January 1st of 2020 to February 29th of 2020. Or you can use any 12 consecutive weeks within this group from May 1st of 2019 through September 15th of 2019. This third one is really put in there for when you have seasonal employees. They're looking at those that employ people during the summer. So you want to sort of go through and do this full-time equivalent calculation. Well, first for your cover period, and then for each of these 3 reference periods. What you're looking there to see is, are my full-time equivalents during the cover period equal to or greater than your full-time equivalents during your reference periods? Once you drop below that equal, you're going to have an issue that part of your forgiveness of the loan might be reduced. All right, there are some safe harbors that will allow you to get around some of these strict rules here and having the full-time equivalents being equal. One is if your business was required to be partially or fully shut down by a government order. If the full-time employees were reduced in the period of February 15th of 2020 to April 26th, and you were able to restore them by the end of December 31st. And to qualify for that last exception, there's some steps that you need to go through and make sure you check off. You want to make sure that you made a good faith written effort to rehire the employee. Or if the employee was fired for cause, or voluntarily resigned, or voluntarily requested or received a reduction in for a reduction of their hours. And then after that, if you're looking to hire them back, you need to have made a good faith offer to restore their hours at the same rate and salary as before, but the employer rejected it. And if the employee rejected it, I definitely would want that in writing as well, showing that, hey, I made an effort to rehire my staff, but they chose for one reason or another not to come back. Or if you simply were unable to fill that position just because you could not find a qualified candidate. Any of these, if you can go in and show that your full-time equivalents were reduced because of these reasons, then your loan forgiveness will not be reduced. All right, we'll just try to do a little summary of the process here for the forgiveness. First thing you're going to want to do is track your full-time equivalents for the pay period and the reference periods. You want to track your non-payroll costs, your rent or your mortgage interest, your utilities, etc. You want to complete the application including Schedule A. The Schedule A is what really sort of walks you through where you spent your cost, how many employees you had during your cover period and during your prior periods, for your test or reference periods. It'll also walk you through all your cost and just sort of work you through the math mechanics of showing that you're entitled to the forgiveness. The other thing you're going to want to do is make sure that you provide the proper documentations to your bank. The bank also will generally have their own application or form online that you can walk through. A lot of those have incorporated that Schedule A in there just to make it easier for you. But you also need to provide the documents. Payroll reports are really key, showing your payroll for your reference period and your cover period. You're going to want to show your quarterly payroll reports here for 2020. So that could be first, second, third quarter, maybe second, third, fourth quarter, just sort of depending on what your cover period is covering, making sure you do those. I would also include bank statements showing payroll payments for your covered period. If you have a building lease or mortgage payments you're going to make, you're going to want to have a copy of a signed lease that was signed prior to you getting the SBA or the PPP loan. The mortgage payments, hopefully you'll have a monthly statement showing how much was interest, so you can submit those. And then utility bills, it's the other thing to show. Basically, if on that Schedule A, you're showing expenses to have the loan forgiven, you need to back those up. Hopefully, then the new act that just passed here late December, the thought was that the SBA was supposed to make this process a bit easier for those under 150,000. The questions will we still have to provide that documentation, or are we not going to have to do that and we can just sort of verify on that application that we have spent it in the correct places? The issue that I've seen come up with some of my clients with the banks is the banks are asking for these documents. I think that the banks are trying to protect themselves a little bit. They're sort of the in-between guy between the SBA and the borrower. And I think that they do not want the SBA coming back to them and saying, hey, you forgave a loan that you should not have. And that would put them in a bit of an awkward situation. So I've seen the banks ask for a little more backup documentation than you would think might be necessary. But that's sort of where we're at. All right, that was quite a bit to go through on just the old PPP round one. Is there any questions?
A reminder, if you do have questions, to please type them in the Q&A area. Also, to let you know, I will be sharing a copy of these slides, so don't break your hand trying to write everything down. You'll get a copy afterwards. I just want to double check with David that he has not edited those since he sent me a copy yesterday.
So far, no, but I think I have edited them every day this last week. Like I said, it's just so new. There's just so many pieces to come through. I think the legislation was over 5,000 pages. So there's a lot to go through, and we're still getting some guidance on some of this. So I will try to keep them up to date, but so far, so good.
Sounds great. And we currently still do not have any questions right now.
All right, we'll move on. Here's the act that was actually signed on the 28th. It's called the Consolidated Appropriations Act. What the big things in there were that they did a lot of clarifying around the PPP loans and the EIDL grants, which was actually some really, really good news came out of it. Because now they've clarified that no amount of the PPP loan or the EIDL grants will be considered gross income. Now I'll just haven't mentioned the EIDL loans. These were grants, not really loans. They were grants of up to $10,000 to an employer, $100 or $1,000 per employee up to 10,000. They were closed down, but they're going to be opening back up. They were refunded with this law. I would say if there's one thing to take away from this, if you have not applied for those, go ahead and do it. It's up to $10,000. It's a grant. It's free money. Right now, the only drawback is the state of Minnesota might tax it, but it's not taxable on federal income. You don't have to repay it. It's a half an hour to go on the SBA website, find it, fill out the form online, and submit it. And like I said, $10,000 for a half hour of work's pretty nice. That's $20,000 an hour rate. I wish I could bill out at $20,000 an hour. So I think that if you haven't done, go out to the SBA site and do it. I think they'll be opening up probably later this week if they haven't already, maybe early next week. So that was a great thing. They won't be included in income. And this is a change because the IRS was holding pretty fast to this, that no deductions will be not denied or tax attributes reduced by result of the loans, either one. What the IRS was looking at was saying, yeah, the loans aren't taxable income, but whatever you spend that money on, we're not going to allow you to deduct those wages or that rent or those utilities. It really was not the intent of Congress on the original act, but the IRS was really holding steady to that. So it was really great to see this bill get signed. That's just going to be huge for small businesses that they don't have to pick that up. Like I said, Minnesota, we're going to talk about that a little bit later, but I just don't know where they're going. Right now, Minnesota is saying that's income. I don't know if it's going to change. They are in session, but we also know that Minnesota is a little bit of a deficit area, so I'm sure they're looking for revenues. The other big part that came about it that I don't think a lot of people other than maybe us tax geeks really thought was a big deal. These loans are going to sort of be treated like tax exempt income. So you're not taxable, but they do add to your basis of your partnership or your S Corp, which is really a big deal when you start looking at the fact that if they weren't, you would have some partnerships, some S Corps here showing some income, potentially be able to distribute some earnings out to the shareholders, to the partners, and not get a favorable treatment there because they had no basis on it from these loans. This basis increase also applies to if anybody has an SBA loan for, say, normally I would see it with your building. There was the section 1112C was from the prior CARES Act, and that allowed the SBA or had the SBA pay 6 months of SBA loan payments. So you may have seen that if you have an SBA payment either for your, say, a building or for starting up your practice. And those also sort of follow under the same thing. The one thing I don't know with those SBA payments, those 6 months, is whether or not you're going to be able to deduct the interest on those payments. We're still trying to find that one out. A little bit of a side note here too, if any students out there received emergency financial aid grants, those are also not taxable to the student. Sort of lumps those three in with that. All right, round two. What's new here for round two? And round two is just getting underway. The SBA just issued their guidance and the forms to apply for the loan. The bank should be opening up any day now. Sort of depends on what bank you went with. Some of the smaller banks, the community banks, are getting opened up a couple of days earlier than, say, some of the larger national firms. So round two, what is it? It's actually $284 billion of potential loans. It's definitely down from the first round, which was 522 million. So if you're going to qualify, and we'll go over those qualifications here in a second, if you do qualify, don't waste time on this one because the funds are probably going to go pretty quick. And it's only available for employees with under 300 employees. And here's how you qualify. You must have had a 25% drop in revenue. And how they're defining that is they're comparing any quarter of 2020 to any quarter, or the same quarter a year ago in 2019. For example, you would take the second quarter of 2020 compared to the second quarter of 2019. And if you can show in any of the 4 quarters, you can choose your quarter, you had a drop of 25% of revenues, then you would be eligible to apply for the second round. The second round amount is going to be calculated pretty much the same way. It's 2.5 months of your average 2019 payroll. There's a couple industries that actually got 3.5 months. They were basically the restaurants and the entertainment business. So not really applying in here. All right. The other new issue here that they came up with is before in round 1, you cannot have a PPP loan and claim an employer retention tax credit. They changed that retroactively, so it not only applies to the first round, but the second round. And we're going to go into this employee retention credit down the road because it's pretty big deal if you happen to qualify for it, especially here in 2021, because it goes through the first 2 quarters. And if you don't qualify for the PPP loan, then there's a good chance that you might qualify for this retention credit. And the credit can get up to, between the 2 quarters, $14,000 an employee, given that you paid them that much. So definitely something to think about. I said the community banks were opening up earlier, some of the smaller ones, and that's because the law actually set aside a portion of the funds to go to, the smaller banks, community development institutions. They were really trying to get it into the small or women or minority-owned businesses, hoping they would have easier access to the funds. That was a complaint about the first round, that it went to some of the bigger companies out there. All right, so that was sort of what's different, what's sort of the same. What they did with that second round is completely separate from the first round, but they really borrowed a lot of the rules. So we'll sort of go over some of those again. 24 weeks to use the funding, same as the last one. A portion that's not forgiven, so you have a portion that's not forgiven, it's still a 1% interest rate. 60% of the funds still must be used for payroll. But the other 40%, they expanded it a bit. So here's a little bit of a change. You still have the rent, you still have the interest utility, but now it applies to cloud computing cost, supplier goods, as long as you had a contract to purchase those goods before you applied for the loan, personal protective equipment and installation cost of those. So that's really helpful. And then other expenses that you had to incur to make your practice COVID-19 safe. So, one of the things, if you are applying for that second round loan, you may want to watch the timing of paying some of your suppliers. If you hold off and pay it during your 24-week period, that might come in handy to get the loan forgiveness, rather than paying them a week or so early. If you've delayed it a week till you got the loan, you might be able to then take those payments and use them for the forgiveness. Any questions on the second part of PPP round 2?
We'll give people just a second to
Right.
type. Lot to take in.
Yes, it is. And I guess one of my hopes is that you don't become an expert in one of these topics, but at least you have enough knowledge to go back to the people you lean on and ask them some questions and say, hey, do I qualify for this? Or, hey, how do I go about that? I think that's hopefully the takeaways you get today is knowing some questions to ask.
And we don't currently have any questions.
Great. We'll continue on here. So we'll start talking about some of the other parts of these tax acts that should hopefully provide some relief for your practice and for you as an individual. Like I said, they extended this economic injury disaster loans. They put 25 million into it. It's a tax-free grant. Like I said, it's $1,000 per employee, the max of 10,000. SBA.gov, go apply. If you haven't done it, go apply. Other employee-related issues that were passed, and if you start looking at these, they're really looking at how do we help the employer keep the employees on staff and employed. And I think I would really look at these as maybe they're a way to do some incentives for retaining employees or encouraging staff to come aboard. Flexibility to roll over your unused FSA dollars. So if you didn't use them all in 2020, it used to always be this use it or lose it rule. Now you can roll them over to the next year. You can also roll from 2021 over to 2022. And if you have a plan set up in there, I would really work at encouraging employees to participate. It saves both the employer and the employee some money. From the employer standpoint, whatever they choose to run through their flexible savings plan does not have Social Security taxes or Medicare taxes on it, so the employer doesn't have to match it. There's a 7.65% that you don't have to pay for every dollar that they roll through a flex plan. They extended the family leave rules now until March 31st. And basically what it is there is they require you to make certain payments to employees if they have to leave due to COVID reasons, either caring for a family member, themselves. There's also a lesser rate if their students are out or kids are out of school. You do get a credit for those wages back on your payroll tax returns, but those just are out there until March 31st. They were scheduled to run out at the end of December. They also allow for a deferral of the Social Security. So the employer's 6.2%, you can actually defer paying those in until April 30th or for the payroll through April 30th. So, if cash is getting really tight, you can do a deferral there. A little bit of caution there is it's not forgiven. It's at some point going to have to get paid. So watch that. The other big one we see in there, and we see this a little bit, is there's new proposed regulations out there that will allow a health sharing ministry to be defined as medical care. What was happening is that you'd have taxpayers that would join these health shares, usually through a religious organization, but not always. But they weren't considered health insurance. So they couldn't deduct those costs, or if you're self-employed, you couldn't treat those as self-employed medical insurance. So I think that really helps leveling the field. There's going to be a little work to be done. You may have to contact your ministry that's running it and make sure you know how much of your payments are actually considered for the ministries or the health share and how much of it might be administrative costs. Because I know there's some guidance and some rules around that in the proposed regs. We'll have to be careful on that one. Continue with the employee-related. Like I said, they extended and increased the employee retention credit. That's really good news for the employers. We'll get into depth with that one coming down the road. This is always an interesting for 2021, 2022. Business meals are now 100% deductible. I think the caveat was that they had to be from a restaurant, which is going to be most of them, which caused us to wonder, well, what if you stop by Cub Foods and pick up some sandwiches or something for the staff and put it in the lounge? That one we'll yet to see. You have all sorts of them. If you go on a Hy-Vee and they have a little diner there, a little deli, it's just a couple places to sit. Is that now considered a restaurant? Is that still more of a grocery store? But for the most part, I think everybody knows what a restaurant is, and at least we can get 100% deductible instead of 50 for a couple of years. And here's a couple of them here that are just sort of interesting ones if you're looking at a maybe unique way to add something to your employees, a little like retention incentive. Employers can now contribute up to $5,250 to an employee's student loan payments under the Educational Assistance Program. Now, I'm going to have to do a little homework there and make sure that you have this Educational Assistance Program set up. I'm sure there's rules around it being non-discriminatory, but it's a way to get some perks to a student, a former student who has loans still out there. And that was extended for 5 years until 2026. The nice part about that is it's deductible by the employer, but it's not considered taxable income to the student, as long as you have the program set up correctly. And kin to that too, there's also an employer-related scholarships that can be set up, and those can work really nice if you have employees who are continuing their education, or if you want a way to encourage them to continue their education, you can help out with that manner. The working opportunity credit extended to wages paid before January 1st of 2026. What the opportunity credit is the IRS, the Treasury has set aside certain work classes and certain employees. And if you happen to be hiring those individuals in that category, you can get a credit for the wages you pay to them. They also extended the employees' referral, be able to defer Social Security's. A little background here is when the CARES Act came out, they were going to allow employees to defer having their Social Security taxes deducted out of their paycheck. This is totally a employer choice. They can go along with this. They didn't have to. And here's my word of caution on that for employers, is the Treasury just said you could do this. They didn't say how you go about collecting those deferred taxes once this deferral period is over. And that's going to end of March of 2021. Is how do you go about collecting them? They just said, you guys figure it out. You come out with a reasonable method. Which, okay, we could go in and tack on a little bit to each and hold a little out of each of your payroll. But what happens if an employee leaves? They really didn't help the employers out with determining how to collect this on an employee that suddenly leaves. So that's one it just seems like there's so many issues with it. I guess I didn't have any clients do it. I guess we really would caution you against it, just because the paperwork behind it is just going to be astronomical. They started getting into this guidance, and they started looking at, well, once you withhold it, now you've got to report it on their W-2. But once you withhold it, now do you have to go amend their W-2 for last year because now they paid it? It just seemed like a real big headache on that one. So you can definitely take a look into it, but like I said, a word of caution to employers on that one. A couple other things here just to keep in mind there is a new Form 1099 for anybody that is non-employee comp. Non-employee comp would be, I guess I would think, who's doing your lawn service and your snow removal? Do they happen to be an LLC or an individual? Do you have somebody that's helping with some of the boarding duties that is not an employee, that's just a non-employee comp? They're just getting paid for their service. It used to go on the 1099 miscellaneous. Now they got a whole form for their own, at 1099 NEC. And those are also due by the end of January. Here's one for anybody. Oops, I went one slide too fast. Sorry about that. Anybody that's formed as a partnership or LLC that files Form 1065, we get final regulations on what they call the centralized partnership audit regime. What that is was sort of the rules about what happens if a partnership or an LLC gets audited. And the centralized rules actually on the surface look sort of good. It was, the partnership, the LLC can handle it. We don't have to hassle and make all the partners and LLC members amend all their individuals. But when we got the final regs and they started looking into it, it gets to be a nightmare if for some reason you do get audited, or the more likely scenario is you end up amending the return, because these audit regimes also apply to amended returns and how you calculate those and what year this audit or this amendment adjustment goes to. And I started looking at that and I said, I don't know why you want to elect out of it. And so I think that's something definitely to go back to your tax preparer and ask, hey, are we electing out of this, and why not? And just see what their reasoning is. Like I said, I'm pretty much going to elect out on every one I do, unless there's overriding circumstances. I couldn't come up with one at the time. So if you can elect out, my suggestion is to elect out. The business energy credit, think solar here. That was set to expire for projects at the end of 2020. Now they've extended that through 2024. Actually, I think the expiration was 2021. My apologies there. But now they extended it for another 3 years. So if you're looking at or ever thought about doing the solar, it's a really nice credit. It's about 30% of the cost. You get a tax break of the solar panels. So it's a nice credit if you're looking at remodeling or doing some serious or new building. They've also extended a credit for energy efficient commercial buildings. So if you're looking at a new one or a major remodel, there's a credit out there if you're making it energy efficient. There's also partial credits out there, say if you go in and do something with the heating and cooling system to make it more efficient, if you meet some qualifications there. So there's a credit out there if that's something you're looking at. And then the qualified business income deduction, the QBID as everybody sort of refers to it as. They were, last year, the IRS were saying for some reason you had to add back charitable donations to figuring out your qualified business income. They've since changed their minds and have moved on from that one, so that's good to know. Individuals, what do we have out here for individuals? As everybody's heard, the second round of stimulus checks is out there. Sort of the same rules as before as far as phasing out. It's $600 per individual, $1,200 for a couple, and you get something for the kids under 17. Obviously, there's been a lot of talk bandied around about raising that up to the $1,200 or $2,000. So we'll see what happens here when Congress gets back to work on some tax stuff here. The other good news is both rounds of the stimulus checks were based on either your 19 or 2020 income. So if for some reason you didn't qualify based on your 2019 income, but your 2020 income, you will qualify. when you do your 2020 return, there will be a sort of a true up, if you will, and you'll be able to determine the credit that you should have got, compare that to the credit that you advance payments or credits that you did get, and apply for the rest of it with your 2020 return. The good news is if for some reason you were advanced more than the credit should calculate to, they're not going to make you repay it. And both rounds are, of course, tax-free, Minnesota and federal. They took the federal unemployment out for another 11 weeks, which is good. They had the rollover with the flexible spending accounts. I touched on that earlier. For those who don't itemize, there's a charitable deduction. It's for 2020, it's $300 per return. 2021, they're going to give joint actually $600 instead of $300. Medical expense deductions, it was set to go to 10% of your income before you started deducting medical. They backed that down to 7.5, which is nice to see. If you happen to be in a spot where the earned income credit or the child tax credits are something you're looking for, you can determine those either using your 2020 or your 2019 income or your 2020 income, whichever provides you the better answer. Did that in a few spots, letting you try to figure out which way was going to work best for you by realizing the income may have been quite different between the 2 years. So that was a nice little spot. Other developments, like I said, the economic stimulus checks, the impact checks are not taxable. Kitty tax, if you have any kids that are getting hit by the kitty tax, which is unearned income for kids actually under 22 if they're still in school. They switched it to using the trust tax rates instead of the parents, which made the calculation really a lot easier. But they found out it wasn't so helpful, and it was causing a lot of the kids to have much higher taxes. So they said they scrapped that, went back to the old, we'll use the parents' rates, which is nice. Is you can go back to 18 and 19 and amend if that was the case. You can choose to use the old rules if it works better for you. If the trust rates weren't bad, then you can stick with those. Required minimum distributions, really nice. They increased this age from 70.5 to 72 before you have to start taking out of your retirement funds, which really provides a nice little planning idea for those who are at that range or getting close to it. What we're seeing happening is we'll have people retire 62 to 65, not collect their Social Security yet. Their income is dropping down into these really low tax brackets, but they have a lot of money in their IRAs that they don't have to take an RMD. They may not even need it at this point. But we know once they start taking their required minimum distribution, their income is going to go really up and into these higher tax brackets. What we're doing as a planning idea is we roll some of the IRA to a Roth IRA or some of their 401k to a Roth IRA, using up the lower tax brackets, knowing that once we start doing the IMDs, they'll be reduced because we'll be managed to keep or reduce their amounts in those qualified retirement accounts. So there's a thought of planning there, especially now with our tax rates super low. Don't see them going lower, maybe higher depending on your income bracket. For 2020, the RMD was not required. The other interesting little one here for 529 plans, they've allowed you to take out $10,000 per student lifetime out of your 529 to pay off loans, which can be sort of nice. And they sort of widen the definition too, is it's not just necessarily the beneficiary, but those beneficiary siblings. So if you have a student, 3 kids, and you have one 529 plan that's in one student's name, you could get $30,000 out there for the three kids, and use it to pay for those loans if you're having trouble getting 529 plans done with Before, you could only use the plan for education expenses in the current year that the expenses were incurred. So this is sort of a nice little way to help people not have 529 plans hanging over. I see we're getting up there in time, so I'll skim through these a little bit fast. If you had to withdraw a retirement plan in 2020, there's definitely some ways to avoid that 10% penalty if it was an early withdrawal, up to at least up to $100,000. Sort of had to be COVID related, but their COVID related definitions pretty open. So take a look at those rules if you had to take some money out of your retirement plan just to get by this last year. They used to have like 3 different ways to get a deduction for continuing education, higher education. They sort of combined the tuition expense and the lifetime learning, and definitely up those income phases. So if you have a student that can't use the American Opportunity Credit, check out the lifetime learning. A lot easier to get starting in 2021. The non-business energy property credit, this is the credit that comes and goes depending on the year. It's back on here now through 2021. Same with the mortgage insurance premiums. They're going to be out there for a couple more years. All right, I'm assuming we probably don't have some questions here, so we'll just keep moving. All right, the employer retention credit. So I've mentioned this a few times. We'll try to get through this pretty quick. What the credit is a credit up to $5,000 per employee who was paid qualified wages between March 12th of 2020 and June 30th of 2021. To be eligible, the employer must have had their business partially or fully suspended during at least 1 quarter of 2020, or had a drop of at least 50% in revenues in at least 1 quarter of 2020 as compared to the same quarter in 2019. Okay, so then you're looking at a pretty big drop in revenues there. And you can do this even if you had a PPP loan. The issue gets to be is you can't use the same wages to get forgiveness of your PPP loan as you did as the wages you're going to use to get this credit. So that's your big caveat. And the wages, which wages qualify? It's the wages you paid for the first quarter where the revenues dropped below 50 through the end of the first quarter that they raised above 80%. So if you qualify for 1 quarter, you're going to get 2 quarters basically. But the second quarter can't be in 2021. It has to be like the 3rd and 4th, 2nd and 3rd. If your revenue for some reason was low for 2 quarters, 2nd and 3rd, you could get 2nd, 3rd, and 4th then. Okay, we talked about that. So you take the credit's 50% of the wages. So you would look at it for 2020, you would look at each quarter up to $10,000 per employee. We'll give you a $5,000 credit for each one of those if you paid them $10,000. As we'll see, they did extend this into 2021. There's a few different rules there. Wages also include a portion of the healthcare costs. Does not include wages to a greater than 50% owner. And if you have, if you think, hey, wow, I think I qualified for that, but I didn't know about it, and I think a lot of the payroll services were not watching for this or thinking about it, you can actually claim the credit for past quarters. And what's really nice is they sort of give you an option. You can actually claim it on your 4th quarter of 2020's 941. That's your payroll tax return. Or you can actually amend that quarter depending on how you would like it to go. But man, if you can figure it out and just put it on that 4th quarter, 941, that's a really easy way to go. I said they expanded it and changed it for 2021. Actually makes it much easier to qualify. The revenues only have to drop by 20%, not 50%. They don't go down to 80%. The test again is, you look at the first quarter of 2021 and you compare that to 2019, not 2020. So that's key. We're normally only going back 1 year. Here, in this case, you're going to be going back 2 years. The other choice is you can compare to the immediate preceding quarter. So, for example, quarter 1 of 2021, you can compare it to fourth quarter of 2020 or 2019. Interesting rule there and how they come up with that, but they give you several options to compare. And again, it only has to drop down to 80% of the quarter. And then the first and second quarter, you must qualify on your own, so there's no carryover until your revenues increase. So you're going to have to look in quarter 2 and compare that to quarter 2 of 2019 or quarter 1 of 2019 or 2021. Yeah, 2020, excuse me. Gets a little confusing. Their part of it is they increase the credit from 50% of the wages to 70% of the wages. So if you pay somebody $10,000, they'll get $7,000. So that's a nice increase. The other thing they did was the wages are per quarter, not per year. In 2020, you maxed out at $5,000 per employee, where in 2021, since there's 2 quarters, you can get up to $7,000 per quarter, so a total of $14,000, depending on your wages paid. All right, that was a lot in a short time. Here's my contact information. Question comes up or wondering about it, feel free to send me an email. I'd be more than happy to answer any questions.
Yep, we do have a question here.
All right.
So just a second. Why isn't it not showing for me? Oh boy, hang on just a second here. Oh, somebody's just thanking you for all of your information. So.
I said it's a lot. By no means do I know all the nuances, but it's knowing when to ask a question and who to ask it to, I think, and hopefully you found a few points in there to go and ask your tax help.
Yes. So I'm not seeing any questions. So David, I want to thank you so much for your time and knowledge today to share with us. And I'd like to thank all of the members who were able to join us today. I know things are still really busy at clinics, so glad you could get away for a little bit and learn from David. And so we hope to see everybody at next month's Lunch and Learn session on Tuesday, February 9th. If not, at the annual meeting before that. Everybody have a great day, and thanks again, David.
You're welcome. My pleasure.